Welcome to the Deep Dive, the show where we cut through the noise, grab the most important nuggets, and, well, make you truly well-informed, all tailored for you.
hmm
And this week, global markets just wrapped up a really fascinating period, especially if you're tuned into what's actually moving the needle.
That's right. And today, we're kind of navigating this landscape using a specific compass,
Yeah,
the Market Summary July 21, 2025.
right.
Our mission, really, is to break this down, give you that shortcut to understanding the latest market moves without you getting buried under all the information out there.
Okay, so what's the headline grabber from this summary then? The executive overview seems pretty clear. Major assets finished broadly higher,
Yeah.
and U.S. equities specifically kept climbing. Sounds pretty positive overall.
It absolutely does. That initial snapshot, it suggests a remarkably positive backdrop for risk assets.
Yeah.
Like the market's ready to embrace growth, maybe, rather than shying away.
And as we zoom in on what really moved the needle, like you said this week, looks like two areas are key. The digital currency markets, which seem to be evolving super fast, and the dynamics in Forex.
Yep. Lots happening there.
Okay, so let's start unpacking that initial snapshot. Let's dive into the macro lens first. So let's begin with that big picture. The summary says U.S. equities are extending gains, still climbing.
Hmm.
What's fundamentally driving that, beyond just a good feeling? Is it jobs, spending, or something else really shifting sentiment?
Well, the source points to two really specific things here.
Okay.
First is that macroeconomic data. It's been pretty resilient,
Right, resilient, yeah.
like strong jobs, decent consumer spending, earnings look good. It paints a picture of an underlying economy that's actually holding up remarkably well.
Okay, that makes sense.
And the second thing, maybe a bit more surprising for some listeners, is getting more clarity on digital asset regulation
Oh.
in the U.S.
Ah, right. The crypto rules we keep hearing about?
Exactly. But it's not just about crypto, really. It kind of signals a more predictable environment for risk assets, generally, all risk assets.
So bringing in maybe sidelined money, people who are waiting?
Precisely. Less uncertainty, more comfort for investors, you see.
Got it. And speaking of broader moves, the U.S. dollar index slipped again this week.
It did.
What's the ripple effect of that for you listening, especially if you're looking at global stuff or even just, planning a trip abroad?
Yeah, a weaker U.S. dollar provides what the summary calls modest relief. Relief for risk assets and emerging market assets.
Modest relief, okay.
So basically, when the dollar is weaker, U.S. goods, services, and importantly, debt, they get cheaper for international buyers.
Right.
And that can free up capital in other countries,
Mm.
making them maybe more inclined to invest in riskier things, or just put money into their own emerging markets. It's like a bit of a global exhale.
A little breathing room. Always welcome.
Mm-hmm.
Now, the summary also flagged two major areas as a focal point this week, crypto markets and FX volatility. Sounds like that's where the real action was.
Yeah, definitely. What's fascinating here is how quickly things like interest rate cut expectations and, shifting signals from central banks,
Yeah.
how quickly that picked up FX volatility.
Right.
It's not just one central bank anymore, is it? It's this intricate dance of global monetary policy.
Yeah.
Every whisper from the Fed, the ECB, Bank of Japan, it sends ripples through currencies. So understanding that FX volatility is, it's critical
Yeah.
for anyone watching global finance.
Okay, so as we think about these bigger forces, one area that's seeing just incredible change influenced by these same trends is digital currencies.
Oh, absolutely.
The summary called it a whirlwind this week. Can you unpack that, maybe starting with Bitcoin? It held up above $119,000, which is pretty impressive resilience.
It really is. Bitcoin's performance has been exceptionally robust. And the summary says this is largely down to persistent spot ETF inflows.
Ah, the ETFs again.
Yeah, continuous demand through these traditional channels, right?
Yeah.
Makes it easier for institutions, regular investors too, to get exposure without actually buying Bitcoin direct.
Mm.
We've also seen strong institutional bids. And get this, the past week actually brought a new all-time high, $123,400.
Wow, okay.
Significant milestone. Now, there was some short-term volatility, bit of profit-taking, sure, and what they call a whale transaction
Which
event.
move by a big holder.
Exactly. But the key thing is the net ETF inflows, still robust. They represent 6.5% of the entire circulating supply now.
6.5%. That's huge.
It's a considerable chunk, yeah, held in these regulated vehicles. It really shows that deepening institutional adoption we've been talking about.
That institutional adoption seems like a massive catalyst, and Ethereum's clearly been riding that wave too. Leading altcoins up over 28% year to date, trading above $3,600.
Yep.
What's specifically driving ETH? It sounds like real momentum.
For Ethereum, the main drivers seem to be the anticipation around ETF approval for staking strategies.
Okay, staking ETFs. What does that mean exactly?
It would let institutional investors not just hold ETH, but also stake it, basically lock it up to support the network and earn yield.
Like earning interest.
Pretty much, yeah, like earning interest in TradFi. And that potential income stream makes ETH way more attractive to big investors. Plus, we're seeing a lot of call option activity.
Meaning people are betting on the price going up.
Exactly. Strong bullish sentiment from the derivatives folks.
And then there's XRP making a sharp advance too, bolstered by positive legal signals, double-digit returns for the week. Seems like regulation's playing a huge role across the board now.
Absolutely. The whole crypto market cap is just above $4 trillion now.
4 trillion? Wow.
And sentiment indicators. Still firmly in greed territory, according to the summary.
Okay, greed. What does that imply, connecting it back? For risk management.
Well, greed sentiment usually means a need for careful risk management, heightened need. Historically, when sentiment gets this extreme, it can be a sign, that a pullback might be coming.
Right. Time to be cautious.
It's when smart investors might start thinking about rebalancing, maybe locking in some gains, instead of just chasing every new high.
And that fits perfectly with what the summary highlights next. Those really impactful regulatory developments in the U.S. This isn't just talk anymore, is it? Actual laws moving.
No, it's huge progress. The source details key passage of the Genius Act for stablecoins.
Okay.
And the Clarity Act for the overall crypto market structure.
Right. Genius and clarity.
Yeah. Genius gives a clearer legal framework for stablecoins, the ones pegged to dollars, reducing uncertainty there. And Clarity aims for a more defined structure for the whole market, like exchanges, custody, that kind of thing.
Got it.
Plus, there's been movement on anti-CBDC legislation.
Yeah.
Basically, pushing back against the U.S. central bank digital currency.
Interesting.
So the combined impact, two things. One, it massively decreases compliance risk for institutions, makes it safer to jump in. And two, it signals strongly that the U.S. wants to be a leader in institutional-grade digital asset adoption, not, fall behind.
So putting it all together, what does this mean for you listening? If you're trying to navigate this space, maybe participate. What are the tactical views, the recommendations from the summary?
It gives some pretty clear, actionable guidance. For Bitcoin, BTC, the advice is reinforce your core holdings. Keep at least a 5% portfolio allocation.
5% minimum.
Yeah, sort of a foundational long-term exposure. A nod to Bitcoin's growing role as maybe a digital reserve asset.
Okay.
And consider adding on technical pullbacks, maybe towards $113,000, upside targets, near $135,000 to $140,000. If those net ETF inflows stay strong, above, say, $500 million a day.
Right, conditional on the inflows. And for Ethereum, ETH.
For ETH, the recommendation is actually increased weighting, up to 10% of your crypto sleeve.
Double the Bitcoin minimum. Okay.
Look for chances to accumulate on dips near $3,300, near-term objective. A breakout above $4,100. And there's even a high conviction year-end target of $5,000.
$5,000 for ETH?
Yeah, they put a 27% probability on that, reflecting those strong catalysts we talked about, like the staking ETFs.
And what about the rest, the broader altcoin market? It can feel like the Wild West out there sometimes.
Definitely. The advice there is for gradual rotations into select top 20 market cap tokens.
Select top 20, not just anything.
Exactly. Focus on compliant large cap assets.
Why?
Why? Because that regulatory clarity we mentioned, it's increasingly driving institutional money towards these more established projects.
Follow the institutional flow towards regulatory safety.
Pretty much. The money's flowing where the guardrails are going up.
Which brings us back to risk management. Especially with that greed sentiment floating around. What are the key tactics for managing risk here?
This summary really hammers this. Use the recent volatility, use it to rebalance, crystallize some profits.
Take some money off the table.
Right. Crucially, avoid overexposure when sentiment is in extreme greed. Like we said, that's often when the smart money starts to trim. And maybe consider using trailing stops, especially on high beta names.
The really volatile ones.
Yeah, the ones that swing more wildly than the market. Trailing stops can help protect your gains automatically if the price drops, without you having to watch it 24/7.
Good practical tip.
The overall message is be proactive, not reactive. Manage your positions.
Okay, so while digital assets are carving out these new regulatory paths, the traditional currency markets, Forex, they haven't been sleeping, have they?
Not at all.
In fact, that same central bank guidance is making waves there too, right?
Big waves.
Let's pivot then. Forex markets. Volatility picked up. What were the key moves in the major pairs this past week, according to the summary?
We saw a few key shifts. Euro USD was at 1.1618, up slightly, 0.2%, but it hit resistance at 1.1645, kind of a technical bounce.
Okay.
GBP USD, though, 1.3397, down 0.8%. Still in a clear downtrend. Suggests underlying weakness there.
Pound still struggling.
Seems so. Then USD JPY 148.85, flat for the week technically, but still has a bullish lean. Eyes are on that big 150.00 level.
The psychological mark.
Exactly. And the DXY index, the dollar basket, 98.06, down 0.20%. It's retesting those multi-month lows.
So yeah, a bit mixed, but the main theme seems to be that U.S. dollar weakness continuing. What's driving that DXY slump specifically? And could it flip quickly if, say, inflation data surprises?
That's the million-dollar question, isn't it? The weakness is mainly driven by lower Treasury yields and softer U.S. inflation expectations. Markets are pricing in Fed rate cuts more clearly now.
Right.
But, and this is important, it's still sort of underpinned by solid U.S. retail data.
So the economy isn't falling apart completely.
Exactly. So while the dollar's easing on monetary policy bets, the underlying U.S. economy isn't necessarily faltering everywhere. Reversal risk, always there, especially with data surprises. But the current bias is towards more dollar easing unless the story changes significantly.
Okay. And what about the euro and the yen volatility? Are those straightforward stories or more complex?
Definitely more nuance there. For the euro, those euro USD gains, mostly a technical bounce, the summary suggests, not really fundamental euro strength.
Right.
Eurozone CPI is stable, but there are still structural headwinds, deeper economic issues.
Got it. And the yen?
The yen's still under pressure. Why? Because the Bank of Japan is sticking to its dovish policy, keeping rates super low while others are thinking cuts or hikes.
Makes the yen less attractive to hold.
Right. But FX desks are super alert for verbal intervention risk once USD JPY gets above 150.
Meaning the government might step in and talk the yen up. Or actually buy it.
Could be either strong warnings or even direct intervention to stop it weakening too much. And this raises a really important question for you listening. Is this USD weakness tactical, just short term? Or is it a bigger structural shift? The summary helps frame that.
Yeah, tactical versus structural, key distinction. So given all this, what are the actionable recommendations for FX from the summary? What trades or positions should people consider?
The advice is pretty specific. First, it suggests shorting GBP USD on rallies. Look for entries around 1.348 is 1.3520, targeting 1.3185. Basically, betting against the weak UK macro pulse.
Okay, shorting the pound on bounces.
Second, initiate a long USD CHF position near 0.7990. Play for a bounce towards 0.8070. The Swiss franc is kind of underperforming because of diverging real yields. Makes the dollar look better against it.
Long dollar Swissy.
Third, reduce DXY risk on rallies. Sell into strength around 98.60 to 98.80. Near-term downside target is 97.70 as those Fed cut expectations solidify, making the dollar less appealing overall.
So fade dollar strength.
Right.
And that final protective measure for the yen, given the 150 level worries.
Precisely. Protectively hedge USD JPY above 150. The summary notes the auction skew is still attractive for volatility hedges.
Meaning it's relatively cheap to buy insurance against a sharp yen move.
Exactly. It's a smart defensive play right now, just in case the Bank of Japan does step in with words or action to boost the yen. It's about being ready before it happens.
Okay, let's wrap this deep dive up. Looking at the strategic conclusion from the source. What are the big takeaways for digital currencies and Forex we should carry forward? The big picture lessons.
Okay, for digital currencies. Those U.S. regulatory breakthroughs plus the ongoing ETF inflows, they really heighten conviction for holding core Bitcoin and Ethereum.
So stay the course with the core holdings.
Yeah, but the summary also emphasizes proactive risk management. Take partial profits, scale positions basically, manage your size as things move.
Don't just set and forget.
Right, and leverage further adoption and clarity as tailwinds. Expect more institutional growth as these assets become more mainstream.
Makes sense. And for Forex?
For Forex, the strategic view is that U.S. dollar softness is probably tactical, not structural, at least for now.
Okay, tactical.
So favor nimble, short-term directional trades, use volatility hedges, especially as guidance from the BOJ, ECB, Fed keeps evolving. Keep those tactical shorts against the overbought GBP and hedge that yen risk at the key levels.
It's really clear from this summary just how interconnected everything is, isn't it?
Absolutely.
Regulation in crypto impacts macro, which impacts central banks, which impacts currencies. It's all one big dynamic system.
Constantly moving.
Yeah.
Demands attention.
For sure. So as you reflect on this deep dive, thinking about this market summary, What does it suggest about how global finance is evolving, especially with digital assets getting clearer rules and central banks always shifting? Maybe consider how these rapid shifts might impact your own understanding of the financial world, or maybe even decisions down the road. What new opportunities or risks might be popping up from all this change?
It really is about staying informed, isn't it? And seeing these patterns as they develop.
Exactly. Well, thanks for joining us on this deep dive into the market summary July 21, 2025.
My pleasure.
We really hope it's given you some clarity and maybe some actionable insights into these fascinating, always changing global markets.